Hello traders, Gary Wagner here. It is approximately 1 o'clock Friday in Honolulu, Hawaii, the 9th day of September, and this is the daily report for gold, our weekend review. What an incredible week we've seen in this marketplace again. Tremendous volatility. On today's report, we'll recap the week as well as take a look at what we are looking at as plausible scenarios for September. All here on today's daily report. Now, gold prices today did close lower. They closed off about $11. Now, the interesting thing about that change is predominant buying actually pushed the market into positive territory by about $11.40. However, at the same time, a strengthening of the U.S. dollar gave it a negative impact, and that was around $22.40. So the market actually closed down $11, but that change is simply due to the relative change in the U.S. dollar as it compares to, of course, the benchmark of gold, with gold finding buyers in the market and actually propping the price up. To give you an idea as to the extreme volatility that we did witness this week, I'm pulling up a 30-minute. It is a Japanese average chart, or what's known as a Heikin Ashi. We were moving to the new record top by the beginning of the week. Monday night, we hit this top, and from there, for the next couple of trading days, we were going to see this market correct, and in fact go from 1920, this new record top, all the way down to this low. I believe it was 1794. Once we saw that, we began to recoup, and of course from Wednesday to Thursday we saw it go from 1784 all the way back up to about 1850. 1850 on Thursday, we saw it dip a little bit. That's right here. This dip itself came to about 1930, which is where we've got some very strong support. Brought the market back up to a secondary high, although below this top. This high took us just shy of 1900, as you can see here, 1888, before having a major correction from this one point. So we saw it go from 88 all the way down to about 1830, and this is where it found secondary support, and then for the rest of the day kind of shored its positions up, as I said, to close at 1861 on the week. We're bringing up a weekly chart, standard candlestick format. 2 weeks ago, you recall, we have this channel line that I have derived from the top of this trading week, which was the former all-time high right around 1918. This is that low of around 1700. You get last week a marketplace that absolutely closed higher, closed in terms of on a closing basis a new record high, and this on a closing basis remains the record high, of course. And then this doji-like candle, once again very similar to 2 weeks ago, with this incredible range, although in terms of the marketplace itself you can see a bottom here of about 1800 to 19. So you've got a $100 range here as opposed to a $200 range here. What is interesting to me is now with this new channel line, and again we have just fixed it on those tops, you notice that the top has followed there. It's trading within the parameters, and my belief is that as this market trades higher, we're going to follow along having support on this lower band, which used to be the upper band, and of course this new band will become resistance. Traders, so what are we looking for next week? I see two very distinct possibilities that would conclude this correction, and we will get more insight as the week begins to trade. Now, here's what I find very interesting, and that is we have been talking about this correction being what is simply known as a irregular top. An irregular top is basically where your B wave is above that of your orthodox wave, and you get actually a new high or a higher high on that. And typically what you're looking at is a 3 count of an A, a B, and then a C correction. Now, the C correction can vary anywhere between above A truncated to A flat and below A called standard. If we get any kind of a deep correction, and at this point I'm starting to think we probably won't, and I'll go into that because that's scenario number 2. If in fact you would see that, of course that would come in and fill that gap. Traders, with this new information available, and I'm seeing a very similar scenario building in silver, rather than a straightforward ABC correction, I believe that the highest likelihood is going to be the witnessing of what's simply called a triangle or a pennant correction. And when we take a look at this marketplace itself in terms of just a Western technical indicator, what you will see is that we've got our flagpole here, and then of course our pennant right from here to here. So it's a flag or a pennant formation. Aaron Elliott called it a triangle correction. He believed that it was simply composed of 5 legs. And the way that would look is as follows. As this market comes up, it makes its new high. This is the orthodox top number 1. You get wave 1, and that's composed of 3. You see that. Wave 2, which is also composed of 3. You would then get your third down, which is here, and then wave 4, which we are currently in, and 4 to 5 would simply go back to the apex, and then you would get a major or sizable break as this range narrows and compresses, and like any pennant formation, you get a release of energy, and that release of energy comes at the conclusion or when it actually reaches the apex. So again, as it comes up, you have wave 1 here, 2, 3, you get 4 here, takes us to our conclusion, and then right here, this thrust is called wave 5. My personal sentiment right now is that of all of the different scenarios available to us, I believe that this is the most likely. And the reason that I believe that, simply put, is because the fundamentals are so extremely bullish on the market. Now, if in fact we get that and this market breaks out, there is going to be a huge release of energy. And that release of energy from the bottom of 5 right in here, I believe will take us to new highs. It will begin the impulse phase, and it will begin the march to $2,000 gold. This has been Gary Wagner wishing you as always good trading, and we will talk to you on Monday for the next daily review. Bye-bye.